Welcome back, everyone. This week I've got something new to be going over. I'm going to be initiating a brand new position into Texas Roadhouse. On Monday, I will be buying my first shares of this company. Hopefully, it will be even cheaper than it is now. But yeah, we're going to be taking a deep dive into this company and going over some of their financials and their earnings that they just came out with, and why I think this will be a good long-term investment. So as I said, I will be initiating a position in Texas Roadhouse, which is ticker TXRH, on Monday. Some anecdotal evidence that I have that this might be a good investment is the amount of people that I always see eating there. First off, I absolutely love the food there, so just by myself, I would love to go there all the time. I've yet to have a bad experience with any of the food there. My entire family loves to eat there, and one of the only reasons we don't eat there more is because it's always really busy and we don't want to wait forever. I tried to go there with my family a few weeks ago, and the wait to get in was over 2 hours. My parents went on vacation to another state and also had a really long wait. Seeing the demand in different parts of the country definitely shows that the demand to eat out, and especially at Texas Roadhouse, is there. As the economy continues to reopen, I think this will continue to do very well. As long as they don't have to restrict capacity again, or even worse, close restaurants down due to the pandemic, then I think they'll do very well into the future. Now, for more technical analysis, I'll go over some of the fundamentals of the company. Now, obviously, they were affected pretty dramatically by the pandemic. As you can see here in their 2020 numbers, they're significantly lower than they were in previous years, but that's to be expected. So over the last 5 years, they had a revenue compound annual growth rate of 5.3%, which is including the 2020 numbers. And if you exclude 2020, they've been growing their revenue at almost 11.5% every single year. Over the last 5 years, they've had negative profit growth over the same time at negative 9.4%, but this is including 2020. And if you exclude 2020, then their profit growth was 14.8% year over year. Their profit fell 82% during 2020, but they still managed to remain profitable over the entire year. As you can see here, in the past, they had managed to pay off all of their debt. And for 2018 and 2019, they had absolutely no debt that they had to worry about. And of course, with the pandemic, they had to take out a pretty substantial amount for them. They took out about $190 million worth of debt. But they are currently working on paying this back. They've already paid off 50 million of the total debt that they took out. So they're definitely on the right track already, and they're working pretty aggressively to get this back down to zero. And their low debt load helped get them through the pandemic without any real worries, because they were able to take out a large amount of debt, and it wasn't really anything too difficult for them to deal with paying off. Texas Roadhouse also just reported earnings on Thursday, where they beat on both revenue and on EPS. Their margins decreased due to the inflation of food prices, and this is what scared off investors, because you can see this really large dip in it where it was in like the high 90s, over 100 in the last week, and it dropped down to the low 90s. So this is another reason why I think this might be a good time to start buying a little bit into this company. So we'll go into their earnings report here, and there's a lot of good information here. Their restaurant sales increased 80% compared to this time in 2020 and 21% compared to 2019, respectively. Most of these numbers I'll be going over 2019 to 2021 numbers, because it's not really helpful to look at the 2020 numbers to now, because obviously they're going to be significantly better. So there's not really a point in going over those. They managed to open 11 new restaurants, including 3 Bubba's 33 restaurants and 2 franchise restaurants. And as of the end of the quarter, the company had opened 11 company restaurants, and currently they're in the process of building an additional 18. And as you can see here, they were working with the amount of debt that they were able to take out, and they've already paid off 50 million. So they had originally taken out 240 million, but they're already down to 190. So I bet within a year or two they'll probably be out of debt again, which is really awesome. The company ended the quarter with debt of $190 million, but they also have $483 million of cash on hand. So if they really wanted to, they could just pay off all the debt, but there's not really a reason to rush into paying it off yet. They can just work it off over the next year or two. With a strong cash position and growing cash flow, the company reinstated their dividend that they cut during the pandemic. With this strong cash position and growing cash flow, the company reinstated their dividend that they cut during the pandemic and raised it from a previous level at 36 cents to 40 cents, a 14% increase. The company also said that they're going to be continuing their share repurchasing plan to continue to buy back more of their company. In their guidance for the rest of the year, they said that they expect to open just under 30 new restaurants and also to expect commodity inflation of 7%. And this commodity inflation is another one of the big reasons that investors were scared after their earnings came out, because they were not expecting that high of a level of inflation. So commodity inflation is definitely going to be a risk here, along with the resurgence of the coronavirus. With the Delta variant that is going around, it is possible that there will be more restrictions on restaurants and they'll have to limit capacity again. So that's a risk that we need to consider. So I wouldn't be like adding a gigantic position into this right away. This will be something I'll slowly add into over time, just in case the situation with the coronavirus gets worse. Even in the case that the coronavirus continues to have a resurgence here in the United States, I think that with Texas Roadhouse's low debt and high cash balance, that really puts them in a good position to continue to make their way through without any huge struggles. Because they have a $300 million credit line, so they could take out another $110 million worth of debt. And then they also have almost $500 million of cash that they could use to get them through that time. Finally, as much as this company might look good just based on their fundamentals, we need to also look to see if the price that it's currently trading at is worth it. I was already considering to initiate a position when it was before earnings came out at like in the $100 range, so the dip is definitely worth it. But we also need to see how overvalued is it on with a model that we can look at. So I will be going to this program that I wrote. So this is the program that I wrote that will carry out a discounted free cash flow calculation using data from Yahoo Finance. It takes past free cash flow numbers and analyst expectations for future cash flow numbers and projects them out and to see what the company's current value is. I based this calculation off of this video that I'll put in the card up in the top right. I got this calculation from Jimmy at Learn to Invest, and he's really knowledgeable about the stock market. So be sure to subscribe to his main channel as well as his Learn to Invest Shorts channel, where he goes through a lot of these companies using this model to give their fair value, and it's really, really helpful. I'll leave a link to both in the description as well. But as you can see, using these numbers, the fair value for Texas Roadhouse is $83.17. And so it currently trades at $92.17. So it's about $9 overvalued, which is about 10.8%. Ideally, I'd like to purchase this under the fair value price by 10%, which would bring my ideal buying price to $74.85. As the entire market is overvalued, my plan is to slowly add to this position, since they took this pretty big dip after earnings because of their decrease in margin and fears of commodity inflation. I figured now would be a good time to at least get started with the company. Depending on the price it opens Monday, I would likely only buy 1 or 2 shares, and if it drops below 83, and especially if it gets to my ideal buying price in the low 70s, I will definitely start buying tons and tons of the shares of this company. I'm going to be trying to keep Texas Roadhouse probably under 3% at the most as a position in my portfolio. So this won't be a major position. It's just another new one to add to get into a different sector because I don't have any restaurant companies other than McDonald's, but McDonald's is kind of different in their business model. And these are some other companies on my watch list that I either have price targets for with all of these, or this one that I think may currently be undervalued, but I don't really know a lot about the company, so I need to do more research here. But yeah, that's my plan for Texas Roadhouse. Uh, it'll probably be just a couple shares on Monday, depending on what the price is. And if it dips down into the low 80s and hopefully in the 70s, I will be buying a ton of it. So can't wait. But yeah, I want to thank everybody for watching. If you have any more, again, if you have any more companies you'd like for me to do an analysis on, make sure to leave them in the comments. If you have any questions for me, you can leave them in the comments, or you can email me at jacobmorrisinvesting@gmail.com. Also remember to like the video and subscribe to the channel if you enjoyed the content. And I will see you all next week. Bye.